Let's start in North Africa, where Egypt intends to suspend talks with the IMF for $4.8 billion loan, saying bilateral aid from Arab nations is sufficient to get it through this current turbulent period. According to the country's planning minister, aid pledged and received so far will enable Egypt to get through this transitional stage. That, however, raises doubts about whether or not Egypt will close a deal with the fund in 2013. The army deposed President Mohamed Morsi on the 3rd of July. It has laid out a roadmap which will see parliamentary elections held in 6 months. Since Morsi's ouster, Saudi Arabia, the United Arab Emirates and Kuwait have all offered Egypt at least $12 billion in cash, loans and fuel. Egypt was negotiating with the IMF last year and through to the better part of this year as well for a $4.8 billion loan, but no deal was arrived at despite months and months of talks. Let's get a little more insight into what's going on in the North African economy. CCTV's Yasser Kim is live in the Egyptian capital of Cairo right now. Yasser, give us the latest reactions to the appointment of the cabinet and the swearing in, earlier today.
Most of the cabinet is technocrats, non-politicians. The couple who are members of any political party have resigned their membership so that they would not be affiliated to any political group. But they are mainly, or 95% are liberals, open to the open market system, and they are, none of them are Islamists, maybe one with a small background of Islamist, but not really. And a lot of them actually, at least 7 were from the previous government. So that's something to note as well.
Indeed. Speaking of institutional memory, let's talk about the budget for the 2013-2014 fiscal year passed by the upper house of parliament. But then the president at the time, Mohamed Morsi, did not sign off on that particular budget. So will it be implemented as is by the current administration, or should we expect some changes to that budget before it's implemented?
I think there will be some changes according to statements from the Ministry of Finance, that there will be a review of this budget. Maybe there will be changes. It was not confirmed, but a review means that there could be amendments, especially after the latest aid that came to Egypt and the budget deficit in the last few weeks. There could be some changes, but mainly it will be reviewed as well by the new government before being ratified by the interim president.
Indeed. Finally, Yasser, we've also seen some quotes from the former investment minister, who's also tipped to hold the exact same post in the interim cabinet, Osama Saleh, saying that he'll prioritize openness in order to attract new investors. Now, in policy terms, what exactly does that mean?
It's quite confusing, to be honest. It's out of the 6 or 7 actually members of the what you can call the economic team in the government. There are 4 from the previous government, the last 2 governments that were by Mohamed Morsi, the former president. So what new will he do? I mean, what does he mean by openness? Well, he elaborated saying that he will concentrate more on openness with the foreign investors, and he will try to help bridging the differences that happened in the last few weeks, months with foreign investors, trying to attract them in, new laws to attract investment, and also to reconcile with businessmen who had problems with the previous government, which he was part of. So to what extent will there be any change in policies? This remains to be seen, because like I said, there are out of 7, there are 4 from the previous government. Will there be changes in the way they approach the investors and the economic policies? We will wait and see how they will do it. But investment and foreign investment is the priority now, to attract foreign investments to Egypt for this government.
Indeed. We'll have to leave it there for the time being, though. Thank you very much for those insights. At CCTV's Yasser Kim, live in the Egyptian capital of Cairo. Let's move on to the other end of the continent, quite literally. South Africa's Chamber of Mines has offered a 4% pay rise to workers in the country's gold mining sector. Now, that's quite literally a fraction of the 60 to 100% rise demanded by trade unions in salary talks, which are being framed as the country's toughest since the end of apartheid 19 years ago. The Solidarity Union, which represents mainly white-collar workers, say the gulf between two sides is a gulf of the exceptionally challenging weeks of negotiations that do lie ahead. The country produced just 167 tons of gold in 2012. That's well down from its peak in the 1970s, when South Africa was yanking about 1,000 or more tons of the precious metal out of the ground every year. Some South African mines operated 4 kilometers or more underground, and that's a depth that imposes enormous costs on companies, which have also had to endure a fall of 25% or more in bullion prices since January. Elsewhere, the United Nations is warning that trade between African countries does continue to decline, despite concerted efforts by governments to boost it. A new report now calls for changes in the continent's economic management models to ensure that African economies can sustain their current growth rates into the future. However, that report comes amid what some analysts are describing as an exodus of capital from emerging markets, as CCTV's Guy Henderson now reports.
It's no surprise that Chinese exports are slowing, but a drop of 3.1% in June has shocked the markets. Imports are down too in the world's second largest economy. Grim news at a time when investors are already beginning to refocus.
What traders did is they were able to borrow money in those countries at no interest rate, virtually interest rate, and they started to use that money and bought into emerging markets where interest rates were higher. So what are we seeing, if you can get the picture, is a reversal of that process. A reversal of the process where you're now selling the rand and you're selling bonds and taking it back to the United States.
While emerging powerhouses like Brazil struggle with public protests and rising inflation, the US dollar strengthens. America's main indexes hit record highs. It's led to talk of a possible rebalancing after more than a few years of stagnation in Western economies. For Africa, falling commodity prices are also likely to hurt. Although, as Barack Obama's visit here last month shows, the continent's still seen as a decent prospect, given its impressive growth rates. Analysts say that as a gateway, South Africa might prove more resilient than its BRICS partners.
One thing that South Africa does have going for it, it does have the rest of the continent as its market. And if the private sector in South Africa can gain momentum both here and in the rest of Africa, then I think South Africa is maybe better positioned in that sense. But that means though that there has to be more synergy between government and the corporate.
There are obstacles though. For one thing, a new UN report out this week shows intra-African trade has been declining, despite an effort to boost it. That same report calls for African countries to up the value of their exports, and that is an area that it has been historically weak at. Now, investors are a fickle bunch, of course, so who's to say whether that money trail might yet reverse again? But if it does turn into something more, South Africa is quite well placed to weather the storm, but it's unlikely to be immune from it. Guy Henderson, CCTV, Johannesburg.
Now, CCTV's Sumitra Naidu has been keeping a very close eye on developments in South Africa's mining sector over the last year. So she joins us now live from Johannesburg. Sumitra, NUM, of course, has rejected the offer on the table from the mining companies in some pretty strong language. But what's the reaction from AMCU?
Well, Rama, we haven't really heard anything official from AMCU as yet. We did hear some reports that they want the Chamber of Mines to actually go back and reconsider that mining offer. But of course, yes, NUM was very upset by the offer, that 4% coming through today. They actually called it an insult and asked for the Chamber as well to reconsider. It is, of course, a far cry from the 61% wage demand that they're actually looking for. But we haven't heard anything much from AMCU as yet on this.
Indeed, I also understand AMCU made a series of last-minute changes to the demands, last-minute changes rather, they would like to see done to the Stability Pact. Do you have any exact idea of what exactly they're looking for in terms of those changes?
Well, this is it. We're trying to get some clarity on this. They haven't come out with anything official in terms of what their demands are in terms of that stability pact. Of course, they weren't present when the other unions and the Deputy President Kgalema Motlanthe was there to sign that agreement, but they said they needed to go back and consult with their members, even though they did have previous discussions before that agreement was signed. But we did hear from certain sources, some people that were in that meeting, that they weren't happy with most of the things that were put down on the table, namely the retrenchments. We do know that Amplatz, did say last year that it was going to retrench around 14,000 people. That later was reduced to 6,000. Those negotiations are still ongoing. We expect to get some sort of decision from them by the end of the month. But apparently AMCU was very unhappy with this, and this is why it didn't want to sign, because it wanted those retrenchments to be stopped. So that's about pretty much what we've got so far. But again, they've been very quiet in terms of what their demands are. So it's not, even on the day of the signing of that agreement, there was no clarity. They just didn't pitch to sign that agreement, and they gave very little detail as to why, just to say that they weren't happy with it.
Let's dig a little deeper into the rationale and the thinking behind the unions. Gold prices are down by well over 25% since the start of the year. Power prices due to rise over the next 5 years as well. And at the same time, at present prices, gold prices essentially put about 2/3 of South African mining companies in the red. Now, face saving aside, what real logical rationale is there for these unions to demand double or triple digit wage hikes?
Well, I think that's the million-dollar question, but I think from the union side, their rationale is that it's the miners that actually make these mines operational. Without them, you wouldn't have any operations. Of course, there wouldn't be any company to start with. So they believe that they need to be adequately compensated for their work. So this is their rationale. But if you're coming through from the Chamber of Mines, it is negotiating on behalf of most of the gold mines, and they put forward a 4% wage offer today. One analyst was saying that this is actually the right offer. If you look at where the market is, I mean, you mentioned 20% for the beginning of the year. Gold prices have fallen 32% since September last year. 14,000 jobs have been lost in this sector in the past 2 years. Over 60% of all mining operations are non-profitable at this point. And this is why this analyst is saying is that this is related to the market. This is all that the miner can actually offer at this point because of all of these costs that are being incurred and the fact that they're not making any profits. This is in line with what they can offer. And of course, the unions not backing down. They're asking for really high wage demands.
Indeed. Finally, Sumitra, AngloGold Ashanti, third largest gold producer in the world, of course, also saying that they're looking at an asset write-down in the region of 2.6 or so billion US dollars. Where exactly are they going to trim their cost base?
Well, they issued a trading update and they gave very little detail. They just said that they would cut back on capital and they would cut back on their overhead. So if you speak to some analysts and they look at it and they try to figure out what kind of costs that you're looking at, of course, there's retrenchments on, that could be forthcoming as well in terms of those cost cutting. But if you look at the overheads, it could be that they want to cut down on their electricity usage. Of course, that a huge cost to the miners at the moment. So if you cut back on that, you may look at closing some shafts down. If you're cutting back on capital, it means that there could be very little expansion, very little investment going into the mines at this stage.
Indeed. We'll have to leave it there for the time being, though. Thank you very much for that. That's CCTV Sumitra and I do live in Johannesburg. We're taking a short break here on BizAfrica. Here's what's coming up next. Home Africa makes history as the first company to list on Kenya's growth enterprise market segment. We'll be live talking to the NSE CEO when we come back. Welcome back. The real estate developer Home Africa is the first company to list on the growth enterprise market segment of the Nairobi Securities Exchange. It's also the first real estate company to be listed at the NSE and the first entrance to a market segment introduced as an avenue for small and medium-sized enterprises to raise capital as required on the capital markets. Now, according to the firm, besides building confidence in well-run, medium and small-sized enterprises as engines of economic growth in Kenya, this listing will provide a way for other potential investors to buy into Home Africa's success story as well. In its disclosure notes to investors, the company attributes its good performance mainly to high demand for land and housing in Kenya, which has led to the sales of vacant lots of land at high premiums and management fees over the last 4 years.
We would like to see as many Kenyan businesses, and there are many, share their businesses with their fellow Kenyans. Come and list. This is why we have had introduced GEMS, so that we can be able to give you an alternative, less onerous, less stringent avenue towards sharing your wealth and your business and your vision and your ideas with your fellow Kenyans. That again is something that I want to congratulate Home Africa for, something that Vision 2030 appreciates Home Africa for.
The Go Africa strategy, and that is where we are moving from here, is to ensure that Home Africa participates in providing homes in the rest of Africa. And we have put all our plans together, and one of our key strategies is to roll out large-scale housing around Africa, jointly in collaboration with Shelter Africa.
Now, of course, of Monday's prices, Home Africa's valuation essentially more or less doubled. But traders, of course, are forecasting quite a bit of volatility ahead. I mean, of the relatively thin trading margins we've seen so far. The question is, what should we expect from the GEM segment in future? To answer that question, we're now joined by the Chief Executive of the Nairobi Securities Exchange, Peter Mwangi. He's live in the studio. Mr. Mwangi, thank you very much for your time this evening. We're well into Q3 2013. Are you still confident that you will hit your target of having at least 3 listings in the GEM segment by the end of the year?
Thanks, Rama. We are very pleased with the progress that we've made so far in the year. Remember that we launched this market in January of this year. We had an election in March, which was disputed until sometime in April. So we are on track, and we are very confident that by the end of the year we will have a couple more listings.
Based on the feedback you're getting, however, from SMEs interested in listing, where is the most interest in terms of sectors of the economy coming from?
We have seen interest from across all sectors of the economy. Other than real estate, like Home Africa, we also have companies that are in technology, in financial services, consumer-facing businesses, as well as some service industry companies. So far, the interest has come from all sectors of the economy.
Indeed. Let's talk about the budget, however. A couple of interesting proposed legal changes as well in the budget that was issued a couple of weeks ago. How will those directly affect the GEM segment?
Well, the GEMS market was in last year's budget. This year's budget also had some exciting things for the market. We have now a framework for real estate investment trusts. We expect that REITs will be listed in the second half of this year. This will allow small investors to participate in the property boom that has been going on by creating vehicles through which they can invest in property assets. We have also seen regulations now for a futures market, and we are working with the regulators and others to see how the exchange can bring to the market derivatives. In the first instance, we are looking at financial features, options on our index, on single stocks, on currencies, on interest rates. Those sorts of products should also be coming to market in the short term.
Indeed. Finally, Mr. Mwangi, private equity firms, of course, have been fairly active chasing deals in Kenya and East Africa as well. And one of the main pitches for the GEM segment was that this is essentially an exit avenue for private equity firms and venture capital firms as well. Are you working in any way with the East African Venture Capital Association to get that to reality?
Yes, we have been engaging not just with the Venture Capital Association, but with private equity players, both as a group and individually. Because as you rightly point out, that liquidity event, that's a listing, provides them with a way of exiting from those investments. And part of the pipeline that we see now for listings is actually from companies that have taken on board private equity investors. So for us, they are a natural ally in developing the capital markets.
Indeed. We'll have to leave it there for the time being, though. Thank you very much for your time this evening. That's Peter Mwangi. He's the Chief Executive Officer of the Nairobi Securities Exchange in our studios here in Nairobi. Probably fitting, therefore, that we go straight into the market. See exactly what your money has been doing. And in nominal terms, the NSE, of course, has provided some of the biggest gains you're about to see on this board. The all-share index in Nigeria is still very much on that bull run we've seen over the last couple of trading sessions, up about 0.4. The all-share index in South Africa, however, down by about 0.8. The 20-share index in Nairobi up by well over 1 percentage point, and the EGX30 also up by 0.85%. That's business for you this Tuesday.